Hi, I'm Nick McLean with Four Pillars Investors. I have almost 20 years of experience in private equity, mergers and acquisitions, investment banking, you name it. I've created a course, a small segment of which follows, and it really is just a very small segment. What has been one of my biggest learnings as it relates to M&A? Probably my biggest learning is that bigger deals are actually easier to get done than smaller deals. In addition to being easier to get done, typically they're often considered much safer than smaller deals. Why is that? Well, there are a lot of reasons. Larger companies typically have more sophistication in terms of the management team, typically more customers. Those customers typically are more sophisticated as well. And for those reasons, a deal with $5, $10, $15 million of EBITDA is typically considered safer, much safer than a deal for a company with $500,000 to $1 million in EBITDA. Now, I'll tell you, you certainly are going to pay more for those larger businesses, but that's why you're paying more, is because the risk is at least perceived to be lesser on those larger deals. Now, even though the larger deals might be less risky, they're still going to be difficult to get done because of the difficulty in finding those deals. For that reason, really going to focus on SBA type deals for this course. Doesn't mean that you are precluded from looking at anything else. I definitely think you should, but most of the tips and suggestions and advice in this course are again going to be for SBA deals. One of the most important factors for an SBA deal is really just looking at size. Now, as you probably know, the limit for an SBA 7A loan is $5 million. There are some options to get conventional loans that are attached to the 7A loan. We'll talk about that a little bit later. But if you think about the structure of the transaction in conjunction with a $5 million cap from the 7A, what that translates to is what I would consider to be a sweet spot for an SBA deal. Really, what I would consider to be the sweet spot for an SBA deal is somewhere in the, let's call it $900,000 in EBITDA mark to maybe 1.3, 1.4. You can go to 1.5, but again, the real sweet spot is probably just a little bit smaller than that. Assuming you have a value-oriented multiple of somewhere around 3 to 4x, you're going to be right square within what the SBA likes to see. If you're bumping up on that $5 million limit, I think a lot of lenders will apply a lot greater scrutiny to the evaluation process. So there's some consideration there. But by and large, you're going to have a lot of options if you're in that $900,000 to 1.3, $1.4 million in EBITDA mark. So what are some of the hallmarks of the SBA 7A program? Well, I'm not going to get into the particulars about interest rates and whatnot just yet. I will talk about that. But first off, I just want to talk about some of the more qualitative aspects of the 7A program. First off, one of the defining features of this program is that a loan will not get denied due to lack of collateral. Conventional loans are all about loan to value and making sure that there's sufficient collateral to cover the loan should the borrower not be able to make payments. That's not in play here with the 7A program. That's why the guarantee from the SBA exists, and it's why lenders are comfortable with what's called an airball or blue sky. Airball is the non-collateralized portion of the loan. Now, different lenders will have different comfort levels with how big that airball can be, but if you have a strong deal that has strong cash flow and your structure and valuation are pretty good, then I wouldn't be concerned about having an airball or having an uncollateralized portion of that loan. I think you still have a great shot of getting the deal. Again, though, all the pieces of the puzzle must be present, and that's what we're going to continue to talk through in this course. Another hallmark of the program, and this is changing a little bit, is that historically the SBA hasn't wanted the owner to participate in any success of the business post-close. That's why for the longest time, rollover equity was not allowed. It had to be a 100% change of control, and a reason why earnouts are still disallowed in the program. Again, that's changing. We'll talk about that more later, but historically, that's been a fundamental part of the loan program. Another component that isn't important or doesn't seem to be as important, even though they might talk about it, is that saving jobs or even adding jobs, from my perspective, just really hasn't been very important during the underwriting or approval process. I think for many government programs, saving or adding jobs is very important. And I think from time to time it's come up, or on a form here or a form there, it'll talk about how many jobs are saved or how many jobs will be added or both. But from my perspective, that is a very minor part in the decision-making process. I say that just because it might feel as though when you're working on a deal for an owner that has no other options to sell their business, I think it should be compelling to the lender that those jobs are being saved, especially when the loan is being guaranteed by the federal government. Unfortunately, it doesn't, so it's just something to keep in mind. The final part that I'll talk about here is the fact that most SBA loans are very covenant light. Traditional or conventional loans will have numerous covenants, such as debt service coverage ratios, such as total funded debt to EBITDA, or who knows what the covenants will be. But oftentimes there are a lot of covenants, and if you break or breach any one of those covenants, then you're on default on your loan, even if you're making 100% of your payments and they're entirely on time. It's kind of an unfortunate situation, because I kind of feel like if you're making those payments, even if you're in covenant default, the lender shouldn't be too heavy on you or too hard on you. But that's not the case for a lot of conventional commercial loans. With the SBA, the covenants that I've seen on the deals we've done have really only been that you have to provide documents that they request. Those documents are personal tax returns for any personal guarantor on the loan, company tax returns, and tax returns for any affiliated entities in which you own 20% or more, or perhaps it's 50%, depends on the lender for that one. The point here, though, is that once your loan is closed, your lender is pretty much out of it. Yes, you want to maintain communication with them and maintain that relationship, because you might want to pursue a future acquisition, or there's 100 reasons why you want to maintain that relationship. But when it comes down to it, there really isn't a lot that they can do, because there are no covenants on that loan. And if you continue to make payments, you are essentially in the clear. Now, I'm not saying that this course is going to be the end-all, be-all for everyone. However, at the very least, if you do want to buy a business, I think you owe it to yourself to at least check it out, learn a little bit more about it, and see if this might be the right next step for you, for your career, and for your family. Thanks for watching.